Welcome to an essential guide on pricing strategy. Today we're diving into the 5 critical C's of pricing. Pricing is far more than just picking a number. Marketers rely on extensive research, and the 5 critical C's provide a robust framework for making informed decisions. The goal of using these C's is to determine the best price, one that offers optimal value to the buyer while simultaneously maximizing profit for your company. The 5 elements we need to consider are cost, customers, channels of distribution, competition, and compatibility. Let's look at each one. First up is cost, the most obvious element. Before setting any price, you must know the cost of doing business. This means accounting for both fixed costs, like rent, and variable costs, such as materials and labor. Knowing these is essential for determining an adequate price. However, cost alone cannot be the sole foundation for pricing. Remember, buyers neither know nor care how much it costs you to produce a product. The second C is customers. They are a critical element, as they ultimately determine the sales success of your product. Marketers must determine what customers expect the price to be, and more importantly, what they are willing and able to pay. Consider the example of Toyota versus Lexus. Toyota targets the middle class with appropriate price points, while Lexus, a luxury brand, commands a higher price, targeting a different market segment. Next, channels of distribution. These are the intermediaries who move products from the manufacturer to the end users. Intermediaries need to maximize their own profits. Therefore, your pricing decisions must account for their expenses, profits, and the value they add to the product. IKEA's global brand uses a complex distribution channel involving manufacturers, dealers, wholesalers, and retailers. The final price must ensure financial satisfaction across all members and still offer value to the end user. Every product faces competition, even unique ones are competing for buyer dollars. The buyer's perception of your product compared to alternatives significantly impacts your pricing decisions. For instance, Royal Enfield and Honda motorcycles compete in the premium mid-size segment with specific starting price points. A much cheaper competitor would not be positioned against their premium offerings. Finally, compatibility. Pricing decisions must be consistent with the brand's other objectives and overall identity. Prices shouldn't be set in isolation. They must align with your established brand marketing and target audience. North Goa hotels target young partygoers with high peak season prices compatible with their willingness to spend. Conversely, South Goa hotels target families and wellness seekers with prices compatible with value and relaxation. Imagine a budget street food stall suddenly offering a very expensive luxury item. This inconsistency with their affordable, quick brand identity would confuse customers and likely fail. By systematically reviewing these 5 critical C's, you can approach pricing with strategic confidence, ensuring profitability and market success. Remember the 5 C's: cost, customers, channels of distribution, competition, and compatibility. Master these and master your pricing strategy.